Hello everyone, welcome to another episode of Financial Tidbits here with me, Royston at NAOF. The topic for today's video is why exactly am I losing money on my cash management account? Shouldn't that be capital guaranteed? Let's take a closer look at why cash management services are so hot nowadays and some of the pitfalls that consumers should be aware of before jumping into this high interest savings account. We all know that interest rates on our savings account sucks big time. By utilizing our savings account, which is generating an eye-poppingly low return of 0.05% per annum, we are in fact losing money. Yes, losing money due to the impact of inflation, which is essentially the buzzword nowadays, with everything around us getting more expensive. That is the reason why higher yielding savings alternatives are gaining a lot more traction, with everyone looking to find alternate methods to save and beat inflation while yet ensuring that their capital is protected in some sense. This is where Robo Advisors in Singapore are jumping on a bandwagon to market us cash management services that are theoretically generating up to 40 times more interest than your typical savings account that your banks are offering. What is equally attractive is the fact that your savings are not locked up for any specific duration. You have the flexibility to withdraw them anytime you deem fit. For the man in the street, this is all under the illusion that your capital in these cash management services is capital protected. That is a major misconception. You got to realize that to generate higher returns, one would have to take on greater risks. There is no free lunch in this world. This is a major point that I hope to drive across to my viewers, that you could still lose money in your cash management service account, and let me show you why. I have a cash management service with Endowus, one of the prominent robo-advisors here in Singapore. They are currently offering up to 2.1% interest on their highest tier cash management service called Endowus Cash Smart Ultra. That is an attractive proposition for me to park some of my spare cash with them, generating 2.1% with no lock-in and potentially using this fund to capitalize on any form of market weakness. This is of course on the assumption that my money is capital protected. Unfortunately, that is not the case. You see, many of these cash management services invest in fixed income bond products. Some are safer than others. To generate higher returns, one will need to invest in riskier bond products. These riskier bond products might be corporate-related bonds, which might also run the risk of default. A recent example is China Evergrande and its debt issues. If the company defaults on its bondholders might have to take a massive loss on their investment. Now, Endowus highlighted that its fund has got zero exposure to China Evergrande. However, one of the funds that its Ultra portfolio is invested in has got a substantial exposure to China and its property sector. That fund is the Nikko AM Shenton Income Fund, which the Ultra portfolio invests 12% of my capital in this fund. That fund has a targeted return of 4% per annum, which is considered very high for cash management services. But to achieve such high returns, it has to take on riskier bond products. That fund alone is down more than 4% over the past couple of months, which is pretty massive for a cash management fund. Equally eye-popping is the fact that after fund level fees rebates, I'm still paying 0.72% in expense ratio for this fund. As can be seen from its top 10 holdings, it is substantially invested in China, with its second top holding being its China Onshore Bond Fund. There are also several other China-related property bonds in this fund, such as China Sunac, which is also one of the property firms with potential debt issues. Its China exposure is a key reason why this particular fund is performing badly. Another reason could be rising interest rate expectations. Now, some of you might be thinking that this is no big issue as long as these China bonds do not default on their payment. First, that is a big if. Second, for bondholders to not lose capital, they need to be prepared to hold these bonds to maturity. Note, however, that the weighted average durations for bonds in this fund is 3.4 years. What this means is that you need to be prepared to potentially have your capital stuck in this cash management accounts for more than 3 years for you to not lose money and generate the promised annual return of about 4%. That is again under the assumption that no bonds in this fund default on their obligation. As a result of bond prices in this fund declining, they are now able to market it as a higher yielding product. Take for example, a stock that pays a dividend. Its yield will become more attractive when its price declines, until the point where management cuts its dividend. A similar situation might be said with this fund, where the higher yield looks attractive until it cannot be sustained because of fundamental issues with the underlying bonds it purchases. So far, my Ultra portfolio is down close to 0.8%, with most of the drawdown happening in October. My original intention is to park some cash in this safe cash management services and potentially capitalize on any market weakness. However, faced with losses on this savings account, it is only natural to have second thoughts on whether I should realize these losses when the opportunity to invest in the market drawdown presents itself. To not lose money, I might have to hold onto the portfolio for potentially up to 3 years, even though this product is being marketed as one where you should have a holding period of just more than 3 months in order not to incur losses. I suspect that the holding period could be longer if sentiments on the China property and its related sectors remain weak. I'm not saying that Endowus Ultra portfolio is lousy and does not serve its purpose. One will need to know the purpose of investing in this category of cash management account and the risk that you are taking. For most people in the street, they will just be lured by the high interest rate associated with this cash management account without realizing that to be capital protected, you might indirectly be locked up for a relatively long duration. For myself, I might look to downgrade to the more conservative enhanced portfolio, which invests equally in both the UOB United SGD Fund and the Lion Global SGD Enhanced Liquidity, both of which mainly invest in investment-grade bonds with a lower bond duration of less than 1 year. Once again, I'd like to reiterate that this is purely my own opinion and I'm in no way implying that Endowus cash management products are inferior. Investors should know the risk that they are getting into for the kind of returns they are expecting, and if those drawdowns are not acceptable, then one should pivot to other alternatives. If you do enjoy this video, do hit the like button and subscribe to the NAOF YouTube channel for more investment tidbits. This is Royston, signing out.